As we all know, two things are certain in life, and that is debt and tax. These two items are something we cannot run away from. And when it comes to investing, we can't escape taxes. And that's why in this video, I want to talk about the secret to tax efficient investing for higher returns. The secret to tax efficient investing for higher returns. So, tax efficient investing is a strategy that focuses on minimizing the impact of taxes on investment returns. The goal is to minimize, or rather to maximize after-tax returns by considering the tax implication of investment decisions. We consider, our investment decisions in line with the tax implication that is obtainable. So here are key principles and techniques for tax efficient investing. Number one is tax advantaged account. Tax advantaged accounts. So in this particular concept, we have individual retirement accounts. We have 401k as well as 403b, and we as well have health savings accounts. So let's start with individual retirement accounts under under tax advantage accounts. We have contribution to traditional IRAs, maybe tax deductible, and earning grew, tax deferred until withdrawal. So when it comes to Roth IRA, Roth IRA offers a tax-free withdrawal, if certain conditions are met. You have an investment in a Roth IRA account. When you withdraw your money, that money is tax exempt, considering the fact that other conditions are met. You also have, the 401k. So in this particular concept, employer-sponsored retirement account allow for tax-deferred growth and contribution, to be tax deductible. Your money will grow, without taxation, without being taxed. And not only that, you have the health savings account. When it comes to health savings account, you discover that it is a high deductible, health plan. It allows for tax-free contribution, tax-free growth, as well as some tax-free withdrawal for qualifying medical expenses. When you invest in this particular account, it is meant for emergency medical treatments. When you withdraw your money, you discover that there is a tax exemption on the money you've withdrawn. If it is withdrawn for health purpose to cover medical bills, you will not be taxed. Number two is capital gain tax management. Capital gain tax management. So in this case, you have what is called a holding period. So we talk about holding period, discover that long-term capital gains for assets held over a year, are taxed at a lower rate than, short-term gains. That is investment held for less than 1 year. So holding investment for the long term would attract a lower tax rate compared to holding it for a short time. You have, tax loss harvesting. This has to do with, offsetting capital gains by selling investments that have declined in value, realizing loss. Once you sell an investment at a loss, you will not incur taxes. These losses can reduce the taxable income and, offset other gains. So once you sell your investment at a loss, of course, the government will not tax losses. They only tax gains. You equally have number three, tax dividend tax optimization. dividend tax optimization. So in this particular concept, you have the qualified versus the non-qualified dividends. Qualified versus non-qualified dividends. Qualified dividends are taxed at a lower rate than non-qualified dividends. To benefit from lower rate, investors, have to, you know, you have to invest in stocks that pay qualified dividends. So once the company you are invested in pays you a qualified dividends, then you'll be taxed at a lower rate. You have a dividend reinvestment plan. So while dividends are taxable when received, reinvesting that dividends, you know, instead of taking out your cash, would help to defer your tax and potentially grow your investment over time. When you reinvest your dividend instead of spending the money, that particular process is tax exempt. You will not pay tax, on the amount concerned. Number 4 is an asset allocation. When it comes to asset allocation, you have, tax deferred accounts for bonds, tax deferred accounts for bonds. So in this particular area, bonds generate interest that is typically taxed as an ordinary income. So holding bonds, in tax deferred account like IRA, like 401k, can reduce taxes on the interest income. So if you hold your bond investment in a typical IRA, or 401k, account, you discover that your interest will be taxed, at a reduced rate. You also have stocks in taxable account. Since long-term capital gains on stocks are taxed at a lower interest rate, holding such stocks in a taxable account can be more tax efficient than bonds. Normally, when you hold stocks for a long time, you are taxed at a lower rate. And if that particular stock is held in a tax exempt account, you discover that you will then pay less in tax. In a tax deferred account, you will pay less in tax. Number 5 is tax efficient funds. Tax efficient funds. Please don't forget to like this video and subscribe to this channel. So we talk about tax efficient funds. So index funds and ETF. You discover that and these funds tend to be taxed, to be more tax efficient than actively managed funds because they generate fewer taxable capital gains due to their lower turnover rate. They tend to hold their money for a long time and their turnover rate is lower, so that will attract a lower tax rate. You also have tax managed fund, tax managed funds. So mutual funds are designed to minimize taxable distribution by employing tax efficient strategies, like tax loss harvesting or minimizing capital gain distribution. So these are mutual funds, their chief aim is to see how they can invest, on a tax reduced, they employ strategies that will secure a kind of tax exemption. So you discover that at the end of the day, you will end up paying a lesser amount in tax. Number 6 is a municipal bond. Municipal bonds often provide tax-free interest income at the federal level and in some cases at the state level and also at the local level. These bonds are particularly attractive for investors in the higher tax income bracket. If you are in a higher tax income bracket, that means that you'll be taxed at a higher rate compared to if you were in a lower tax income bracket. So you don't want to be taxed at that rate. You could then, invest in municipal bonds. Number 7 is a tax efficient withdrawal strategy. Tax efficient withdrawal strategy. In this particular strategy, discover that when withdrawing from an investment account, consider the tax implication, the impact of tax on that withdrawal. For example, withdrawing from a tax deferred account like an IRA or a 401k can trigger ordinary income tax, while withdrawing from a taxable account may allow you to pay only capital gain tax. And so considering withdrawal from tax advantage account, last to allow deferred, tax deferred growth for as long as possible. So whenever it comes to withdrawal, you consider the tax efficiency of the withdrawal you're making, whether it favors you or it does not favor you. Number 8 is strategic gifting. When it comes to strategic gifting, you discover that donating appreciated stocks or other assets directly to charity can allow, can kind of allow you to avoid paying capital gain tax, and on the claim that it is a charitable deduction enabling tax efficiency to kick in. And so when you, instead of donating cash to charity, you could donate and appreciated stocks. If your stocks appreciate and you donate those stocks to charity, to your favorite charity, then your taxes in that particular regards, uh, will be uh, will be there will be no capital gain tax on such donation, and so you do that in a tax efficient way.